Head of Equity Investments and Strategy at Julius Baer, is now with us on the show. Rupen, hi, afternoon, and thanks for joining in. What's the outlook now on the markets? We've seen the markets correct sharply in the early part of April and bounce back equally sharply.
Yeah, hi, afternoon, Reema. So you're right, we had a big yo-yo in the market, specifically in the month of April. And India probably is one of the few countries who YTD now is giving positive returns at a nifty level, while mid and small caps are still lower. Uh, if you look through, Rima, Indian markets actually, if at all we were to use that term bottoming, we did not, when this tariff tantrum came into the picture, we did not breach the previous low, which was closer to 21,800. So now, probably in hindsight, we can say that was the bottom of the market, and that was before all the tariff related news came into picture. Why were we down? Because we had corrected before all these global issues, because the earnings were slowing down and the economy was slowing down. So, what we believe that now we are entering a bit of cyclical recovery in macros. So, in India, what we believe is the government capex, which first half of last year, if you recollect, because of election was not there. So probably this year, the government will front load the capex. Secondly, the RBI has been pretty supportive for growth with rate cuts and a lot of other measures. So RBI also wants growth. Plus, monsoons are also going to be good as per the early indications. And also the effect of the tax cuts will come into picture from 1st of April onwards. So all in all, we might be seeing a bit of cyclical recovery. So from a market perspective, unless something on the global scale, which as of now you and I can't predict happens, I think we are pretty constructive in the medium term as far as market is concerned.
Rupen, run us through some ideas. That's stocks where you think there is still opportunity, because stocks have snapped back very quickly, and before you can say anything, I mean, valuations are in many cases without any incremental change in earnings or anything, or maybe it's all, of course, based on what future projections will look like, but nothing is very meaningfully changed. It's looking better generally, but it was we always knew, right? I mean, maybe second half of as we get into the thick of the new fiscal year, things will get better because of easier liquidity, etc. Where do you think there is still sort of serious value price dislocation, which one can take advantage of?
Sure. Yeah. Hi, afternoon, Prashant. Well, this market definitely is going to be a difficult market because we are not in an era of, as you rightly said, there were sharp moves on the downside and equally sharp move on the upside, and probably we are, back to where we were. Here, the pockets of opportunity would come through, in some of the segments. I've been saying this on your channel for quite some time. BFSI as a space has been looking good and actually has been one of a better performer in last few quarters. Within BFSI, while the top 3-4 banks have done well, what we believe now that since the overall credit cycle is or the NPA cycle has been pretty stable, credit cost has been pretty benign, and liquidity coming back into picture. So some of the mid-tier banks, also specifically some of those banks in which we have seen a change in management, and some of the key KMPs from a large bank has joined as a CEO of those new banks. Those we believe might be a good turnaround candidates and are ripe for a re-rating. Some of the other segments, as I said, consumption, specifically on the low-end consumption, we believe, as I just explained about some of the tax measures will come into play, rural recovery thanks to monsoon, and also the inflation is benign. And for the first time in 3 years, the real wage growth, specifically for that daily wage earner, is going to be positive. So the low-end discretionary consumption will clearly be a winner, and those segments have been ignored by the market. So be it footwear, apparels, QSR, liquor, all those segments, definitely we find opportunities there. And amongst a contrarian, not contrarian, but one sector which probably again on a YOY basis would see a better year next year is going to be cement. So that is one segment which we believe should do well. So these are some of the ideas which we are looking into. But yes, at an aggregate level, there are not many value opportunities, so to say.
Would you call IT a value opportunity? Because you like large cap IT and you've liked it, you've been constructive on it for a while. So a few questions here. One, did you ride the downturn in IT over the last 3 months where we saw IT stocks correct nearly 25%? Two, are you buying at these levels? And three, what kind of a return can IT stocks give? Even if they're attractive valuation-wise, there is no growth. So in the absence of growth, and if we have about a 3, 4, 5% kind of a growth, then what kind of a stock price return should we expect?
Sure. So, Reema, in fact, we had significantly reduced our weightage in IT towards end of last year, and we have been underweight. And as we speak today, we are considering the kind of fall which we have seen in the stock prices. We are more constructive on IT as we speak. And if you look through, IT has a very strong correlation with IT index with Nasdaq. So historically, whenever Nasdaq has done well, IT has done well, and vice versa. And this year Nasdaq is down, and IT also index is down. That's a strong correlation. And IT as a sector, in fact, large cap ITs, if you were to just do a YOY or calendar year calculations, the differential between the 52-week high and 52-week low for IT stocks is one of the highest. So be it the large names also, typically we see that 20, 25, 30% movement between the lows and the highs of the year. And that's always happened. Why has it happened? Because obviously because of the news flow. And as you rightly said, currently we are in a IT down cycle, so to say, and probably in a US down cycle. So from 92 till now, there have been 4 or 5 US down cycles. And so far, there hasn't been a single year in which the IT has degrown. So coming to the current scenario, what has happened? Yes, all the headwinds, what you articulated, is there and to some extent is known in the price. IT stocks are pricing in a significant US slowdown, if not recession. But now at valuations, so a lot of these large companies, and typically all the IT companies are a classic, I would say, mature industry, which, as you rightly said, growing at 4-5%. Probably this year might be lower and next year might be slightly higher than that. With an 80% on an average payout, when you go below 20 PE, your overall dividend yield or FCF yield works out 4 to 5%, depending on what kind of valuation you are trading. So in an environment in which we are, while we have seen a good rally from the lows, but globally still things can be murkier. So if one wants to play defensive, probably the maximum negative news is more or less there in the IT. And it would be a good defensive bet, and that 4% dividend yield, and if it falls to the 5% dividend yield for those stocks. And historically, we have seen stocks bouncing back from here. So sorry for the long answer, but we are constructive on large cap IT names at the current juncture.
Okay, I wanted to ask you, why not mid-cap IT? Because that is where the growth is, right? I mean, large-cap IT is growing at 3-4%, but you got companies like Persistent, Coforge, which are growing very, very strongly, 25, 28 times earnings FY27. But that is for our next conversation, Rupen. Thank you very much for joining us. Good speaking with you and appreciate your time here on CNBC-TV18. We'll take a quick commercial break here. We're going to come back with what's happening in dealing rooms. So Nimish will help us with that. What's on his chatter list today. And of course, some short-term trading ideas coming up as well.